Good morning and welcome to the Killik & Co market update. It's been another week with lots of big market movements. The continuously changing tariffs have unsettled investors and led to a lot of market volatility. We can see this by looking at the VIX index, which is sometimes referred to as the fear index. The VIX analyzes the trades in S&P 500 index options, and it gives an idea of the levels of expected future market volatility. Here's the index over the last year. When it gets above 20, we tend to say that indicates higher volatility. Earlier this week, it briefly hit a level of over 60 as investors digested the potential impact of the huge tariffs that were announced on so-called Liberation Day. The biggest move we've seen in markets this week was a positive one when an announcement appeared on the Truth Social platform about a pause in reciprocal tariffs. Here's the post in full. China was accused of showing a lack of respect to world markets, and it will therefore be hit with a higher tariff of 125%. That was later increased to 145%. And all other countries will be granted a 90-day pause and a lower reciprocal tariff rate of 10% during this time. Markets rose very strongly after this post. The NASDAQ Composite index was up over 12% in a single day. Here's the 6-month chart. Just look at that recovery. The 12% rise was actually the second biggest rise the index has ever had in a single day. On this chart here, we have the top 5 biggest positive moves in the green and the top 5 biggest negative moves in the pink. Often the biggest positive moves happen very soon after the biggest negative moves. As you can see by the bottom row on that chart, the index dropped over 9% in a day in September 2008, and then it gained over 9% in a day the following month. And that is why it's nearly impossible to time the market. There has been lots of speculation as to what triggered the decision to pause the tariffs for 90 days, and one reason was likely the movements in the yields of US government bonds. Bond yields rise when bond prices are falling, so bond yields will go up when investors are selling bonds. This chart shows how the yield on the US 10-year government bond has moved over the last 6 months. The pink box shows the upwards move since Liberation Day. The upwards move suggests that investors are no longer as comfortable lending to the US government, and the higher yield will mean the US government will have to pay more interest on new government borrowings. Fear of the yield moving even higher was probably a key factor in the 90-day pause decision. The latest US inflation data came out this week, which also has a key bearing on future interest rates and future bond yields. The figure for March was actually a bit lower than expectations. Here's the 6-month chart. The March CPI figure was 2.4%. One reason for the lower inflation figure was lower oil prices. Oil is a key input in the global economy, and inflation tends to come down when oil prices are lower. Here's the Brent crude price over the last 12 months. You can see it has declined this year, and this will have fed into the inflation data. However, the impact of tariffs will not yet be included in the inflation data. This will start to feed in from next month, and at that point we could start to see higher inflation as Americans will be paying more for any products imported from abroad. And finally this week, a bit of company news. Tesco has published its latest set of results and has warned of an increase in competition between UK supermarkets. A few weeks ago, Asda announced it had plans to cut a number of its prices. However, Asda has a huge amount of debt, and it has to spend a lot of its money on paying the interest on this debt. So there is a question mark over whether Asda really has the scope to be cutting its prices. Here's the Tesco share price chart over the last 5 years. You can see it's had a good run, although it has weakened over the last few weeks. Tesco remains by far the biggest supermarket in the UK in terms of market share. Here are the current market share figures. Tesco has a share of 27.9%, while Sainsbury's is in second place and doesn't have much more than half that share at 15.2%. Aldi is now number 4 with 11%. The Competition and Markets Authority here in the UK has just announced it is looking into the supermarket sector. At the moment, there is a rule that prohibits a lot of the biggest supermarkets from putting clauses into their property contracts that forbid competitors from opening stores nearby. At the moment, Aldi and Lidl are exempt from that rule, and the reason is that the rule was introduced in 2010, and at that point Aldi and Lidl had very small market shares. However, a number of supermarkets have recently complained that the rule is no longer fair because Aldi now has a market share of 11%. Please do give us a call if you'd like to talk about Tesco, the UK supermarket sector, or anything else mentioned in this week's video. Moving on to have a look at next week's calendar, we're expecting results out from a few European names, LVMH, Sika and ASML. That's it from us. Have a great weekend, and we look forward to seeing you next Thursday.